Investors should demand higher rates of return for greater risk. And the idea is that if you take more risk, then you get higher rewards. But is that actually true? Is it a good idea to take more risk? We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. I hope you all had a nice long Labor Day weekend. Over Labor Day weekend, I was giving some thought to the fact that we had seen sort of a spike in volatility, and then that drifted back on fast money last Friday. One of the last things I happened to say was I thought buying some puts, 30 delta puts on the S&P made sense. On this live stream, we've talked about some risk mitigation techniques on more than one occasion. And we've also taken a look at various levels of the VIX and whether or not those were predictive of better or worse returns going forward for the S&P more broadly. And as I thought about that, one of the things that occurred to me, we've gone back because we have VIX data, interpolated VIX data going back to 1991. One of the challenges, of course, is that 1991's over 30 years ago. So that's a decent amount of data, but there is, of course, more S&P data than just the VIX. And the principal driver for the VIX level, for options premiums generally, is realized volatility. So the higher realized volatility gets, generally speaking, the higher options premia will be. Now, there's a couple other dynamics going on there, but some of that doesn't matter that much because we only learned how to price options more appropriately after the crash in 1987. So even if you did have options data that went back to, say, 1980, or when the first OEX options were listed, the handful of single stock options were listed on the Chicago Board Options Exchange, as it was then called in 1973, that wouldn't do us that much good. And that's because the Black-Scholes model was sort of taken at face value. People would plug it in and do their calculations. So what I decided to do was instead take a look at realized volatility and see whether or not that had any, we'll call it predictive results if we went back further in time. So I went back to late 1928 for that. We're going to get to that in just a second. But before we do, I wanted to just talk about the idea of the efficient market hypothesis and the notion of risk and return. So let's start with the latter part first, which is that all else equal, investors should demand higher rates of return for greater amounts of risk. And in an efficient market, we would probably expect that you would get it. What would be a really simple way to think about that? Well, you could buy the S&P, or you could use leverage to buy the S&P. And the S&P generally rises over time. So over all periods, going back about 100 years or almost 100 years worth of data, you're looking at 30-day returns in the mid-60s. You're looking at annual returns in the 7 to 8% range. And of course, if you used leverage, if you were always levered, you would achieve higher rates of return, reflecting those returns with the degree of leverage, less the cost of your borrowed capital, which is going to fluctuate. When interest rates are high, then it's going to cost you more. And when they're low, very low, as they have been recently, it's going to cost you much less or virtually nothing. If the market is efficiently priced, then we would expect that when you see higher degrees of volatility, which is one measure of risk, it's not the only one, but it's a measure of risk, then you would expect to get higher rates of return. So I've got a couple slides here. I'm just sort of going to go through them, and we're going to talk a little bit about what they mean. Now, I tried to boot up my PowerPoint earlier, and it sort of froze up on me, so we're going to see how this goes. I might have to just go back to not doing the slideshow, and we'll see how this is. Okay, so this is PPL Corp. PPL Corp is an electric utility. And what we're looking at here are two things overlaid against each other. And in blue we have the price for PPL Corp over the course of the last year. Now, this is through last Friday because I did these slides over the weekend. And you can't really tell from this, but trust me when I tell you that the returns here in terms of price are a little over 28%. So we can see that it appreciated nicely, up a little over 28%. And because PPL pays a very handsome dividend over, even at the current higher price, the yield is over 3%. The total returns, inclusive of dividends, over the course of the last year was close to 32%. So quite good. Let's compare that to what we have in orange. Orange reflects the peak to trough drawdowns. So if you look at the early part of the year, you can see we had a rally. It then fell from, it looks like it got up to almost 26 bucks, just shy of it. It then fell back to $22 and change over here where my green cursor is, if you can see that. That decline was the biggest peak to trough decline in percentage terms that PPL had all year. And the orange, so the highest the orange line can be is 0% because we're only measuring how much it has declined, not how much it has rallied. And this is just another way to think about risk. So at any point in time, what's the most you could have lost over some period if you bought the stock that day? So we can see that the biggest drawdown was just over about 12%. The drawdown axis, by the way, is delineated over here on the right. And this drawdown that we saw in early October of last year, late September, that drawdown was about 12%. The second largest drawdown occurred in, it looks like late January. That was a decline of just under 9%. And then, we can sort of see how things went. So 32% total return. Worst peak to trough drawdown was about 12%. So I'm going to compare that now to Teradyne. So Teradyne is a semiconductor company. You can see the price again in blue and the drawdowns again in orange. And here we had returns of about 26%, pays a small dividend, a modest dividend. The total returns over the course of the last 52 weeks were about 28% and change. So very good. Comparable, we could say, to PPL Corp, but not quite as good. But the drawdown characteristics are much, much different. The largest drawdown we had in the first 6 months was the drawdown that took place in late October, early November of 2023. That drawdown was about 22%, so very nearly double the largest drawdown that PPL experienced. It then had 3 more peak to trough drawdowns that were in the neighborhood of 14%. And then most recently, in August, we saw that its peak to trough drawdown was almost 30%. So this is anecdotal. It's, much like people telling stories when they're running for office. Cherry picking 2 stocks doesn't necessarily give us hugely meaningful data, but I use these as examples that, when you start throwing darts at a board, you can find that the risk-reward characteristics of different security selections are indeed very, very different. So the next question we might ask ourselves then is, okay, well, what about the market overall? Are we rewarded for taking risk? And I just skipped through slides because this thing wasn't responding, so bear with me while I try to flip back and forth to where I was trying to get, so bear with me for 1 second. I'm going to wait. So the next question would be, when the market gets more volatile, and we've done this exercise a little bit with the VIX, when the market gets more volatile, are we rewarded with better returns going forward? So now this is a rather convoluted chart, so let me walk you through a little bit of what we're looking at here. First of all, we can see that this goes back quite some ways in time. All right, so this goes back to actually to late 1927, but it's really early 1928. And what it is, in blue, this spiky thing that you're looking at, That is the 30-day realized volatility for the S&P just rolling through time. And these lines that I've drawn on here in orange, green, and light blue. So, that zigzaggy chart is just all data. In orange, that reflects the median of the 30-day volatility through all of that time. So what does that mean? It means that half of the time 30-day volatility was below that line, and half of the time 30-day volatility was above that line. Now, I'm using the median in this case. This is something I've discussed before, but I just want to bring it up here too. The reason is that when it comes to volatility, it's a mean reverting process, and it can be very low for a period of time, and then it has these incredible spikes. And those big spikes in volatility throw the data. So the average isn't, what happens 50% of the time. It's actually a much lower number, what happens 50% of the time. So that's what the median represents. So we can imagine that half of the time the market is below that orange line in terms of 30-day volatility, and half of the time it's above it. The green line, for what it's worth, that is the actual mean, right? So that's the mathematical average of all of this data. And then the light blue line is the 80th percentile. So that means that 80% of the time volatility, and you can sort of see that by looking at the chart, right? You look at this and you can say, okay, well, most of the time it's below that. And I chose that because that happens to be where we closed on Friday when I was looking at this. All right, so the question I had was, well, we can figure out what the 30-day, 60, 90, 180, 1 year, 2 year returns are for all data. Why don't we take a look at what that would be if you bought it when volatility was above the median? What if you bought the market when it was above the mean? And what if you bought it when it was above the 80th percentile, which is where we find ourselves now? And this was the results that we found. So perhaps unsurprisingly, what we see is that when it comes to 1 month returns, so remember that I made these colors the same, right? So all data is the dark blue, median is the orange, mean, the average, is green, and above the 80th percentile returns is in light blue. Now this is a lot of data. We're talking about 25,000 trading days or so. So when you're talking about the 20th percentile, we're talking about 20 years worth of trading data. So it's not a small sample. When you look at 1 month, 3 months, 6 months, you can see that there are differences in the returns. But those differences are not hugely meaningful. But as we go further out in time, the pattern that you start to see in those shorter periods becomes more pronounced. So if you look out, and this is all data for the S&P, 1927, late 1927, December 27, through last Friday. So if the S&P returned on average 8% per year, if you bought it when volatility, 30-day realized volatility, was above the median, those returns fell by about 1% to 7. If you bought it when it was above the mean, it fell a little bit more. And if you bought it when it was in the 80th percentile, you can see that it fell to about 5.5%. So 5.5% returns per year versus 8% per year is a pretty big difference. And it's not just that the returns are lower, it's that the risk, at least measured by volatility, is higher. The median volatility is about 12.7%. So that means that 50% of the time, the standard deviation for the S&P is below 12.7% per year. And the 80th percentile is about 20%. So that means you're going from getting 8% with relatively low volatility to getting 5.5% with relatively high volatility. Take a look at the 18-month returns, and we can see that you get something fairly similar. You're in a higher volatility regime, and the returns on average are lower. 2 years out, similar thing. And I bring this up because, as we start to see the market chop around a little bit more, there's like trained seals, investors have been taught you buy every dip and never sell, basically. So you buy every dip, and there's good reason for this, right? So buying all the dips, one of the reasons that we've been trained to do this is, of course, because policy responses have strongly encouraged it. We have aggressive monetary policy interventions when we see any sign of financial distress. And that obviously propels risk assets. And at least recently, we have seen pronounced fiscal deficits as well. And a lot of the hiring and economic activity that fiscal deficits can create can inflate economic activity somewhat, and then we have to start giving some thought to whether or not that's sustainable. Leaving that aside for a moment, I just want to offer a couple other things to think about. So this is price to sales. In this case, I'm only going back to early 91 because that's what I happen to have data for. I could probably go back a little bit further in time with some work. This is price to earnings. Trailing, last 12 months in blue. Forward earnings estimates in orange. All-time highs? No. But we're kind of getting up to, these upper reaches. I mean, we can see that recently we were in the upper reaches, and we're not far off of it now. We certainly are above average, and we are certainly above the median. Let me actually go back for 1 second and just take a look at this one. So price to sales. So price to sales is very close to all-time highs. I have talked about this before. In fairness, a very high price to sales, we have companies that are profitable in a way now that we've never seen in the past. And we talked about that a week ago. NVIDIA's 70+% margins. But what are we finding now? Well, suddenly we've got the administration going after them and antitrust concerns. Won't get into whether or not we think that's a good idea or not. It's kind of a deep discussion probably. But it is, at the very least, it's a risk that folks have to think about. That when the margins really do explode, that there's always the possibility you will attract unwanted regulatory attention. So this chart now that we're looking at is the Buffett ratio. The Buffett ratio is the value of publicly traded equities in the United States relative to GDP. And we can see that we're at more than 2x, or at least we were as of Friday. It may be hovering just below that number right now because we've had 2 days of declines. I've previously shown this one too. This is just parallels that I've drawn to prior market drawdowns where we saw prices increasing but price action getting more volatile. This was Cisco in late 99 and early March of 2000, and this is NVIDIA more recently. And of course, NVIDIA has traded even lower since on obviously some of this news that we saw. Okay. So, I bring this up because I think it's worth, at the very least, thinking about whether you want to aggressively buy dips in this environment. And I think my answer to that question is, not really. And I think that's supported a little bit by some of the economic data that we've been seeing more recently. The other thing is that if we do start to see rates coming in and we do see deflationary pressure, one of the things that investors haven't really had much success in recent years, but over the longer term was generally considered to be a relatively good and safe strategy, was that notion that you would split your investments between equity and fixed income. In general, I think that over the long term, equity is where you want to be, but I do think that if we have deflationary pressures, then bonds actually can be a respectable place to be. So I don't think it's a bad idea to hide out some portion of your cash in assets that are, at least still now, before we've had any meaningful declines, the rates on these things are still decent, right? So 5% is not bad in a call it a 2.5% inflation world where you're concerned about equities. And then you can just deploy a bit of that as you get, say, a market correction, which would formally be a decline of 10% or more from the all-time high. So let's just take a quick peek at what that would represent. Of course, a bear market you could dip in even more. So we're just going to take a quick peek at what these numbers would actually represent. I mean, we're pretty close to these all-time. I could go back to here. Why not? We'll do it formally. Why not? So just say 10% would take us down to about 50, 77, 50, 75, and a 20% decline would be, in and around 4,500, right? So those are the kinds of levels where I think it would make sense to get more aggressive. The other thing I would say is that on a short-term basis, if you're looking for even bear market rallies, when one of the things we illustrated, I think, in a prior live stream was that when the VIX got over 30, 35, I don't remember where I had actually drawn the line, that you began to see meaningfully better short-term returns and meaningfully better short-term probability of profit. So I'm talking 30, 60 days out. I think with the VIX above 35, your probability that the market is going to be higher based on historical data is actually well over 70%, over 75%, I think, is actually some of the data that I've seen, compared to about 60, 62%-ish over all periods, right? So that's a meaningful improvement. And you start to see, 30-day average returns go up from, it depends what window you're looking at. So all data, 60, 70%. Modern era, if we'll call it that, since 1991-ish, equity returns have actually been much higher. So in the 80s, the mid-80s, we're talking about bumping those mid-80 numbers over 100 bips in the 30-day time frame, and a much higher probability of profit. Those things work hand in hand, of course. Okay. So I just wanted to leave everybody with those ideas at the very least before we move on and take some questions, which is what I intend to do now. So, Bob, was there any chance, to be so prescient. Yeah, right. Okay, so I guess we should have expected at least one question on NVIDIA. It is, after all, so it's the busiest single stock option on most days. Let's take a look at what it actually ended up trading today. I don't know, but I'm sure it was a huge number. Jeez. 4.5 million contracts. Yeah, that's a big number. Let me see. We're gonna let's see what the total options volume was today. So we traded 22.5 million calls. That's everything: index, ETF, single stock, and 19.1 puts overall. So 4.5 million contracts traded in NVIDIA. We traded round about 41 million contracts. So it's more than 10% of all volume measured in terms of just contract quantities. That's not necessarily the best way to do it, but and if we pulled out ETFs and index, which typically trade huge volumes, SPX, SPY, Qs, things like that, we are, on average, I think we saw that NVIDIA has been about 20% of all single stock options volume. So I should expect that if anybody's interested in options at all, if they traded any single stock option, it's a 1 in 5 chance that they traded NVIDIA options. So I guess I'm not that surprised by that. A couple of things. So one of the things is that before we went live today, I don't know whether it was Jay or Brad, both of who are involved with the production of this live stream. One of them said, wondering if Nancy Pelosi sold her NVIDIA position before this news came out, which I'd be very interested to see. I think we all would. But fairly interesting. The thing is, we have new news out, and that kind of throws some other things, into a little bit of a whirlwind, so it's a little bit harder to see. But why don't we take a look at what some of the technical indicators are saying right here, and what we can see is that, and remember, when I look at this, included in this list, number 43, buy and hold, that's not a technical indicator. It's just in here as a placeholder. And what you can see is that actually right now, most of the short-term technical indicators remain a little bit bearish. So, if I'm going to look for some measure of support, I'm going to look for prior sort of lows and figure that people might be interested in, trying to find opportunity there. I'm also going to be looking for unfilled gaps to see whether we might be looking to get back through there. The good news is that this unfilled gap from May, that has actually already been filled. So, as I look at this, let's just put the 150-day moving average in here. Probably the first number that I would take a look at. This is kind of an important area, I think. We bounced off the 150 over here. We bounced off the 150 back in 2023. Let's go back in time a little bit. So this obviously was a bear market. Everything was sort of, but we can see that this has been a reasonably meaningful level. That right now is, 102. We're awfully close. So this is I think a kind of a critical juncture that we're looking at right here. And if it does break through that, then I would probably start taking a look at these other lows that we had right in here. So that's going to be in and around 92 bucks. Failing that, 80. So, now actually, let's be fair. I mean, these are not insignificant declines, but call it 101, 102. I mean, what are we talking about? 3.5%, something like that. Not a huge deal. Not a huge amount of risk for something that obviously has done as well as this. Even 90 bucks, 15% decline. That's obviously nobody wants to accept a 15% decline if they don't have to take it. But we've suffered these kinds of declines before, and in fact, very recently, it's done it once already this year. So we should at least expect that in light of everything that's going on, which is that we have, a regulatory inquiry, we have a market that's getting a little bit choppy, we still have a lot of other sort of important news to break. That kind of a drawdown, that amount of risk is not out of step with what we've been experiencing in the stock over the course of the last 12, 24, 36 months, and so on. So, not sure how hugely helpful that is, but those are my 2 cents. To buy every dip requires infinite cash. So that's, it's an interesting idea and a fair point. From an institutional point of view, recognize that most of the bigger buy-side shops are actually, their assets are growing over time. You're managing 401k money. People are constantly depositing, so it's sort of a natural course of things that the asset pool grows, not just as a function of the increase in the value of the assets themselves, but because of a constant influx of new investment capital coming from the savings of investors. As you start to see a bigger portion of the population retiring than people coming in, that's when you can start to see that kind of a thing reverse. So that becomes a secular headwind rather than a tailwind. So something to think about. So what we're really talking about is fresh capital when we say buy every dip. So, presumably people are saving. What do they do with their savings? Keep some in cash. Right now I kind of feel like there's nothing wrong with that. The truth is, though, that for a lot of people who are collecting savings and they're putting it in automatically, depositing to the 401ks, that money actually, that process is usually fairly automated. People they rarely check their 401k statements probably, and they certainly are not manipulating the selections that they made. You remember when you got your job and they said, what kind of an investor are you? Are you speculative? Are you conservative? What's your time horizon? Are you aggressive? And so on. And you were offered a handful of choices of potential investments, and every single time you're making contributions, that money is just going in there, and chances are you're not changing it. And that money is, so what we're really talking about is how do the institutional managers of that money deploy those new cash deposits that they get over the course of time. That's one part of it. So anyway, but you're right, of course. Nobody has infinite amounts of cash. The other interesting thing, actually, is that oftentimes what you will see is that the total margin balances at market peaks are relatively high, and they decline as the market declines. People are taking risk off the table. So that's kind of the opposite of what you would think or suspect or suggest, which is that you're long, and when you believe that it's a better time to invest and you see that multiples are, maybe that would be the time to actually take a little bit of leverage. Two things tend to work in your favor if and when you do that. Number one, that panic tends to reduce the asset prices. Two, those are usually, or at least recently, those things have been surrounded by environments where the cost of borrowing has declined, because we see short-term rates typically dip, and those are what guide margin rates. So the cost of capital to deploy it in this way is going to be lower. But different ways to think about. What happened in NVIDIA today? Perception is sometimes better than reality. Well, what's been going on, of course, is this inquiry into whether or not there's some. And this is kind of interesting to me. Antitrust concerns are usually driven by anti-competitive behavior. That's when we usually think about it. Not when people are innovating something novel, something new. It's kind of an unusual thing for us to then say, okay, well, that's just not right. Why do they have a monopoly on it? Well, if I invent a pill and that pill suddenly makes you, faster, smarter, thinner, just as some sort of magic pill, and it does all of these wonderful things, and I say, but here's the downside: this pill is going to cost $100,000 a pill, but it does there's no downside to it. People are going to fall over themselves to buy it. The rich, of course, aren't going to think twice. The poor are going to borrow money to do it because they think they're probably going to get richer if they have all of these attributes, and consequently, I can charge anything for it. Nobody else has the magic formula. Well, is that anti-competitive? Well, no. I came up with something nobody else did, right? So, and it's worth probably every penny of the 100,000. But that doesn't mean that there isn't going to be some politician or bureaucrat for that matter, who's not going to try to make some political hay off of the situation. And I think that might be what NVIDIA is experiencing a little bit of here. And to imagine why that might be true, consider potential remedies, right? So when the trust busters came after J.D. Rockefeller and Standard Oil, over 100 years ago, the Ida Tarbells of the world were concerned about what was going on. What had happened was Rockefeller and his partners had, basically taken complete control of the refining operations, and they used their power basically to control other players. And that was a very different thing. It wasn't that they invented refining or shipping and transport and logistics of oil and its byproducts once it had been refined. Refining is sort of where they focused their time and attention. It was less speculative than the E&P side. And they did, in theory, create a better product. That was the reason, by the way, if nobody knows, that was why they called it Standard Oil, because at the time the quality of refined products was such that you could buy gasoline, you didn't really know what you were getting. They wanted you to know that you were always getting the same thing. They were going to set the standard, and the standard would be consistent. Standard Oil, that's where that came from. But they did have practices, and they were not unique in this. The railroad barons also tried to take advantage of monopoly power. And in fact, they tried to do it over the oil business for a time. The reason they measure oil in barrels is because that's how it was shipped, and it was shipped by rail until such time as they said, yeah, you know what, maybe pipelines are a better way. In any case, my point in all of that sort of sidebar is that you can imagine a remedy for anti-competitive behavior. Anti-competitive behavior would be behavior that, basically manipulates prices for shipping and transport, squeezes people out of the business, basically forces them to sell their product to you or to sell their businesses to you. And then the more of those businesses you acquire, the more control of the industry you have. Compare and contrast that with the magic pill idea. Well, it's something completely novel. You're not forcing other magic pill sellers out of the business and then jacking the price up. There was no magic pill. There is no magic pill that makes you thin, smart, rich, and all the rest of it. So it's not necessarily anti-competitive to charge whatever the market will bear if you invent such a thing. It's a very different thing. So that's, I think, a little bit of what I find a bit perplexing about going after NVIDIA on trust concerns, antitrust concerns, because the migration from CPU to GPU is obviously something that they helped create, but there's good reasons for it. So until people come up with competitive products, they're the answer. So what is the remedy? In the remedy of the Standard Oil case, you can break them up. You can say you acquired all of these companies, you took control of the whole market, and we're not going to allow that. So we're going to break those companies back up again, and they're going to compete with each other. We did the same thing with Bell. What's the remedy for NVIDIA? What, are you just going to hand their technology over to somebody else? And that hardly seems like a just thing to do, like the right thing to do. I would actually argue that if they make the margins so great, and their margins are great, gross profit margins in the mid-70s, that's pretty great, a free market would suggest that it's going to encourage others to try to compete. That could include even potentially people that have some pretty good understanding of the inside workings at NVIDIA, who just say, you know what, we can do this, and maybe we can create a very competitive business, and we can do it even with gross margins of the 40% variety, and just over half of what they're getting, and we'll all become multi-billionaires if we can achieve this. And that competitive pressure might actually create the competition that at least regulators right now would seem to desire. So take some time for those things to play out, but I would imagine that the free market would sort those things out eventually. I'm not really sure what a regulated resolution or prescription for this situation would otherwise be, though. Okay. Let me get here. Let's see. Let's see. Hi, Mike from M&M. Any thoughts on going long TLT calls into December, lower rate environment? Okay, so this is really interesting. So as I was just pointing out, I do think that bonds are a reasonable place to be. I kind of prefer the 5 to 7 year time frame probably more than the really long end. So this is an interesting thing. Let's take a look at a yield curve just so that we can kind of think about this a little bit. The rates that the Fed can control any and all rates if it wants to. It typically can control the long end of the curve by the Fed's balance sheet. And the shortest part of the curve, spot rates, overnight rates, are typically controlled by things like the Fed funds, right? So, and that's the expectation. So Fed funds at 5 3/8, and the expectation is that this number is going to come down. The curious part here is that, so we can see, we can see the SOFR swaps rates and all the rest of it. But here we can take a look at what the yields are on U.S. bonds going out in time right here. So, and as you go further out in time, the rates are higher, but they're not so much higher. The interesting thing that can happen is that let's think about what rate changes can do. If I jacked short-term rates from 5 3/8, where they are right now, to 10 3/8, what would happen to the long end of the curve? You know, as we kind of work through that, what happens? Well, if I bring short-term rates up so sharply, it's going to smother the economy, right? Why do we do this? We do this to bring down inflation, to slow economic activity. Well, it could be theoretically deflationary. You could slow things down so much that you could say push right past recession, right into depression. And what happens to that? This is highly deflationary, right? So if something is highly deflationary and we actually expect negative economic growth, well, the long end of the curve, which is going to be essentially all of what we can imagine, if you thought that was going to persist, that could actually push the long end down a little bit. So it isn't as simple as the Fed saying, okay, well, we're going to move rates from 5 3/8 to 3 3/8, down 200 basis points, or we're going to take it up. It can have some, we kind of expect the curve to breathe up and down somewhat, but we also expect it to invert and to steepen. And steepening is what we expect if they get aggressive, right? So if they get aggressive in terms of stimulative activity, they drop short-term rates to 0. If they don't control the long end, then we expect the long end actually to rise as the front end declines on expectations of higher inflation and higher economic growth. So that'll push up the long end, and then they're forcing the short end down. So TLT is really long dated. We're talking about 20+ year treasuries, and it has a lot of duration. And of course, because of that, there's two things. One, the rates are not huge at this point, 4 and change. But the other is that high duration, a function of the length of time to maturity of these 20+ year treasuries, is that they are highly sensitive to long end interest rate increases negatively, right? So as rates go up, what happens to bond prices? They go down, they go the other way. So my preference would be to be sort of in the belly of it, in the middle of it, 5, 6, 7, maybe trip Bs, stuff like that. I'd rather, I think, that than out on the long end. Two reasons for this. One, the yields are better on those. Two, they have less duration risk. And three, the lower cost of capital benefits the businesses, right? So that would probably be my preference, would be to be in that neighborhood rather than getting long the TLT. You buy the long TLTs if you really think we're going to get something highly recessionary. And there's a difference between saying that I think that there's some economic pressure that we're experiencing, which I do think we see, and expecting highly recessionary pressures that are going to basically put a lid on 20-plus year Treasury rates or actually drive them lower than they are right now. I'm not saying they couldn't go a little bit lower, 15, 25 basis points. I think they could. But a whole lot lower? Not so much. And by the way, if you want to understand what kind of risk that actually represents, you need look no further than how TLT actually behaved as the long end rates went higher. So here we are. TLT's all-time high was August 4th, 2020. Is that right here? That's here. Okay. So there we are. August 4th, that's July, but it doesn't matter. That's close enough, right? TLT fell 52% over the period that I'm charting here. And I would bet that people who were buying long-dated US Treasuries in mid-2020 had no concept whatsoever that this was the kind of investment risk that they were taking. If you had said, you could have a 50+% drawdown in 18 months, would they have bought that? Well, certainly not. Would Bank of America have loaded their balance sheet with long-dated U.S. Treasuries? Would Signature Bank, would Silicon Valley Bank have done this? Might they have actually spoken to some of their compatriots over at JP Morgan and said, to the extent that you can't actually lend the influx of deposits that you're seeing, maybe there's a better place to deploy it? What I'm saying is, without getting too hysterical about it, that there is a little bit more risk there. And if they get really aggressive in monetary policy and we start seeing inflationary pressures, and if they don't do something to keep a lid, it's not like we're going to have any shortage of Treasury issuance, by the way. Run deficits the way we are, there's going to be plenty of paper around, right? So they can't let that curve get completely out of control, so that's the good news, because it's just going to become a solvency problem. But don't expect to see long-dated rates. You trade that end as a rate bet on the long end of the curve, and by buying it, you're betting that the rates are going to go a lot lower. I don't know. I think that's I don't see that. I can see 25 basis points, I guess. And if we get better inflation prints and some moderating economic data, more than we've seen, that's something to think about. But yeah, look, I've said it. I like fixed income, but I'd probably look at, at least investment grade, which is going to be BBB minus or better, 5.7 duration, in that neighborhood, right? Okay, so your analysis makes sense about the vol at the 80th percentile producing lower rates of return. Do you think this also applies to extremely high vol? My sense is vol greater than 30, we should be selling puts and getting long more. So Monday AMQB, a couple quick things about that. Yes, I agree with you. And yes, that is actually what my preliminary analysis of the data suggests. By the way, the high vol we're talking about here is I'm actually taking a look at realized volatility. In other words, not what the options market is forecasting, just what the market's doing. And I think it's kind of important to think about this as well. We can try to there are other things that go on that can propel index options prices, like SPX options prices. So I think I mentioned before, the dispersion trade apparently is very crowded. It's a trade I used to do. I don't do it anymore, so I can't really speak to it from a practitioner's point of view to tell you whether or not it is crowded, but it's believable because it's an attractive trade to be in. You get to play off of the dispersion of the single stocks. It's a nice trade from a stat vol arb trader's perspective to be in. So it's entirely believable that folks are doing it. It's entirely believable that there's a lot of premium selling strategies out there. And the nice way for a market maker to take advantage of that is to buy single stock premium, sell index as a hedge against it, and wait for dispersion to do its thing. So that dynamic though, if the trade is crowded, suggests that there could be distortions in those prices. And actually, we did see some evidence of that. So back of the napkin, if you just take a look at the ratio of SPX, SPY, that whole complex of options prices relative to single stock, it was getting to very extreme levels, meaning that index was very cheap relative to all of the weighted volatilities of the constituent stocks, at least on a historical basis. And that is it's kind of a tricky place to be. Two reasons why. One, we're in uncharted territory, which by itself for any financial market is something that every investor should try to pay attention to. But there's something else, which is that when markets get into meaningful disruption or drawdowns, correlations rise. And if you are long the dispersion trade, you are short correlation. You're either betting on dispersion or you're betting on the opposite of dispersion, which is correlation. So if you're in that position, then what that does is it creates an environment where you could see some unwinding. Unwinding could come from market makers covering some risk. That's a portion of it, but I think they're well capitalized and they're amongst the smartest players on the street. So I'm not going to get too panicky about what happens to Ken Griffin's guys or Jeff Yaz's guys or anybody else like that. But I will say that those types of dynamics can actually add a little bit of fuel to the fire. If you have ETPs, exchange traded products that are short premium on any kind of a levered basis, which are an equity-like product, the investors can't contribute additional capital or they can't be called upon to do so. So that also creates a forced unwind. And so all of those things create a little bit of interplay, which is one of the reasons why when volatility spikes, it can spike so quickly and so violently. And sometimes you get things that don't make a lot of sense. I mean, during the GFC, we actually saw a situation, very brief, couldn't trade it, couldn't take advantage of it. I saw it, wanted to, but nobody would actually make a good bid, so I couldn't really get into it. But I actually saw a period when implied correlation got to something like 1.3. Well, that's an arbitrage, right? Correlation can't be higher than 1. So if implied correlation, that is the index prices get to a point where you can sell index premium on a weighted basis for more than it would cost you to buy the single stock options on all of the constituent stocks, that's an arbitrage. So that's, things can swing around. Other forms of theoretical arbitrage or distortions that we didn't think we would ever see, include something I did a video about some time ago, which is when WTI contracts traded negative back in, I think it was April or May of 2020. And, in theory, that shouldn't happen, but, there are functional reasons why it can. And some of that comes from exchange traded products that just get a little bit lopsided. Then you have a lot of open interest that has to be unwound and has to deal with it. So we're looking at realized volatility, but yes, what you say is something that I think holds. And Corey Henderson, following up on that same concept. Yes, the VIX above 30, 32. Look, I looked at this at a couple different levels, above 30, above 32, above 35, above any of those numbers. Short-term returns in the S&P are statistically much better. That's what the historical data shows. Whether, of course, the VIX data only goes back to 91, but that's enough. There's enough pieces of data in there to say, okay, I think we have a sample size that's meaningful enough to do. And by the way, the sample size thing, I'm going to bring this up for one quick reason, and that is that we're in an election year, and I often hear people talk about, well, in election years this and in election years that. Well, presidential election years only happen every 4 years. And if you're trying to look at, say, the VIX and election years, well, you already have a problem with your data because you only get that once every 4 years, and we've only got 8 elections within the period for historical data of the VIX that we have. And even if you go back to, realized volatility, and you're trying to just make generalizations about those years, it's bumping up against any kind of against a meaningful sample. So, and that's not to say you dismiss it. You don't. The way I would, the analogy I would make is this: We care about how single stocks behave going into quarterly earnings, and we may only have a limited amount of data for it because they only report 4 times a year. So 10 years is only 40 earnings reports. So how many generalizations can we make? What we can know is that things might bump around a lot more than they usually do. So we pay attention to them. But you can't do all kinds of really fancy extrapolations from that data because you just don't have enough of it. That's the point I would make. Okay. Capri to be bought by Tapestry for $8.5 billion, $57 in cash. If Trump wins, this would likely go through. If not, Capri drops to the mid-20s. So do we think Lena Khan's going to do something about Capri and Tapestry? Are they facing FTC issues? I apologize if this is well known and I don't happen to know it, but that was not on my radar, if that's true. So anybody who knows anything about that, please drop that into the live stream comments right here and now. That was not. This didn't seem like something that was going to be in the crosshairs for the administration. I didn't think, but if anybody else knows anything about that. Yeah, so actually, so somebody, one of the producers, producer Jay, just made the point. Let's ignore for a second whether or not we actually think there is, actually this is a teaching moment. So there is something valuable to go into here. And particularly because what we're dealing with is, as you point out, a cash deal. Yeah, actually, so I'm glad you brought this up. I don't know anything about antitrust concerns and whether or not one administration might actually try to put the kibosh on the deal. But there is a couple things that you ought to know or think about whenever you're dealing with takeovers, the implications for options and the implications for how you deal with the potential breakup of a deal and so on. First things first. What are things that companies can do when they acquire another company? They can pay cash, which is the case here. They can pay a combination of cash and stock. They could pay all stock. All of these things have implications for the value of options on the target company and potentially the acquirer too, depending on the size and scale. What are those implications? Okay, first thing, if it's an all-cash deal with a high probability of success, implied volatility, the extrinsic premium of those options is going to basically get sucked out and go to zero. And the reason for that is very clear. That's because if you hold a share of stock and it's going to be, you're going to get $57. Well, $57 in cash doesn't have a lot of volatility. Cash is not a volatile asset in the terms of cash, right? $57 is not volatile in the terms of $57. It is what it is. So that means that the extrinsic premium goes down. Partial takeover, partial stock, partial cash. So let's say 50% cash, 50% stock. Let's say that both of these companies had implied volatility and realized volatility of about 30% prior to the deal. What do we expect the new implied volatility of the acquired shares to be prior to the closing of that deal? It's going to be about 15%. Why? Because half of it is cash, zero vol. Half of it is, and I'm ignoring the possibility that the deal breaks because that introduces a little bit of vol as well, of course. But assuming that it's understood the deal's going to go through, volatility of the acquired should be 15%, and the acquirer, assuming it hasn't changed, remains at 30 because half of it is zero vol and half of it is 30. That gets you to that average. Okay. And if you are going to be converting into the acquirer's stock, then the volatility of the acquired stock will be whatever the acquirer's stock vol is. Those should converge, of course. That is exactly as we would expect. So what are the implications of this? One of the implications is that if you know or believe that a company is going to be acquired, so let's say you are a risk arb guy. That's what risk arb is. Risk arb is speculating on future corporate actions or events and the impact that those can have on the underlying stock price. So you would be speculating in this case on a merger or an acquisition. So one of the things you would not want to do if you have a stock that's trading $50 and you think that it's going to go to 57 because you know that there's going to be a cash takeover, is going out and buying the 55 strike calls, long dated. Because while the stock is going to run through that 55 strike by $2, you know this, it's going to be a cash deal, the extrinsic premium is going to go to zero. The best thing that could happen to you would be to actually be short that premium at the 57 strike or above, or basically short extrinsic premium in general, because it all gets sucked out. The good news is that if you have a situation where you believe, you have reason to believe, and your odds calculation give you some form of an edge over a deal breaking, and it's an all-cash deal, the options premiums are going to be very, very low to do that. And consequently, you should be able to, therefore, put on trades to bet against the deal happening and take advantage of that. The issue that you have right here is that as we take a look at Capri's pricing, at least, some of these options premiums are pretty wide. But an all-cash deal should suck the extrinsic premium out. And what you could do, I would assume, is that and we're probably waiting for some normalization to take place here, but if and when it does, you want to start acquiring vol in and around the spot price, maybe slightly in the money. So risk arbs will very conventionally also buy stock and then sell any premium at or above the target price, the acquisition price, because they figure that's just found money. And they're just trying to milk the last couple basis points out of the deal. And so if extrinsic premium gets down to such a level, then sometimes, if the deal breaks, you can benefit not only from the direction, but the fact that some premium is going to come back into it. But right now, that does not appear to be the case here. Let's take a look at Tapestry premiums, what we got going on here. Yeah, spreads are pretty wide as well. Why are Capri implied premiums so high? This is, it's interesting that the premium on this is, so the market's actually, they're applying a relatively low probability that this goes through. Let me check the comments. I want to see what you guys have to say. What is going, it's interesting. So the implied probability that the deal closes is based on the current stock price for Capri and the options premiums, which are, remember what I was saying before, extrinsic premium should go to zero, and it will if the deal goes through because it converts to cash. So when you see extrinsic premiums, when you see implied volatility, 80%, 90%, that tells you that right now the active market participants who are playing this deal aren't assigning a very large probability that it's going to go through. That's supported by the fact that, at least according to what I just saw, there's 55+% return premium in Capri if the deal should go through. So yeah. It's, it's one of these things, I just don't, what an odd battle to pick. Capri and Tapestry. This is the existential economic threat that the administration has decided to hang its hat on. Hard for me to figure this one out. This is an interesting thing. So I'm going to be doing, I'll bring this up now. I'm going to be doing a live stream tomorrow because we didn't do one on Monday. So I'm going to do one tomorrow at 1 p.m. Eastern, 10 a.m. Pacific, so that we can capture a little bit what's going on intraday. I'll look into this a little bit more. Yeah, I mean, I unfortunately can't keep my eyes on absolutely everything. Absolutely everything. That makes it sound like I'm looking at 80% of it. I'm not doing that either. But I hadn't looked at this very closely, to be honest. And I'm going to look at it a little bit more and try to see what other folks in the space are talking about and thinking about. Okay. So, lots of activity in Fastenal. We'll see what the activity was today. And yesterday, we can see, this isn't one that trades a whole lot of volume, typically 1,000 contracts or so. This is the 20-day average over here. And yeah, we can see that we saw a pile of these SEP 65 puts trading. And to look at this a little bit more precisely, let's see, did we get any blocks? Take a look. So, is that we saw 4,000 of these things. And by the way, just judging by the time, these were almost certainly related. Over here, these other contract blocks that took place right around 10:33. So we saw a 4,000 trade for about 75 cents at 10:33-ish. So let's take a look at what the market for those was just prior. So why don't we take a look at it from, say, 10:30, because that 4,000 was a block, so that was a negotiated print. And we'll go to 10:34 and see how things were looking before that trade went up. Okay. Yep, there we go. Okay. So we can see that the market before these trades started to actually hit the tape was 55.70, 65.70, 65.75. Then we saw a pile of those things trade for 75 cents. So that was an institutional buyer. Got somebody to commit on the wire, traded some in the market, and volume picked up from there. So yeah, bit of bearish flow in there. Most of that happened this morning. So the next question is, what? I mean, they picked a specific date. What happens between now and the 20th that could be meaningful? And this, so we don't get any earnings, but we do get their sales and revenue release on Thursday, Friday, excuse me, right? Today is the 4th, 5th, 6th. Yeah, so Friday. So that's obviously what they're playing for. This is another one we probably should look into a little bit more deeply tomorrow, and see whether there's anything proximal that we can try to see, whether we can get at least a thumb in the wind for how things are looking. Not behaving spectacularly well, but then I guess nothing else is right about now. Oh, we break below the 150, it looks like, and we may have even, do we form a death cross here? Yeah, we formed a death cross right there. So a little over a week ago, we formed a death cross. That's not great. not like it's really necessary to look at the 150 when you have that situation, because by definition, you've pretty much you've violated it before. So the death cross followed the break below the 150, which happened early in August. So I think it's the put activity we saw today is almost certainly a bearish speculative bet ahead of Friday's number. I was just reminded that I have now kicked it up over an hour. So here's what we're going to do. Since we are going to be doing a live stream tomorrow during market hours, not a long time to wait. I will finish up including some conversations about, so I see that TC is looking for 5 to 7 year, so you're looking for sort of midterm treasury bond ETFs. I was really looking at corporates personally. Like I said, lower investment grade is probably fine. Beneficiaries, so their spreads, the idea being that as their capital costs come in, maybe we'd see some spread tightening if we start seeing a couple things go their way. But we are going to be doing the live stream tomorrow at 1 Eastern. So if you had a question and I didn't answer it, and also so we can look into this Capri thing a little bit more. I think that's kind of interesting, and honestly, I hadn't paid a lot of attention to that deal. But we can pay a little bit more attention to it tomorrow, unless something else suddenly strikes me as being way more interesting. We can obviously go in another direction if that happens. But until then, so less than 24 hours away, tune in for that one. Like, subscribe, comment, do all of that kind of good stuff. And thank you for tuning in today. Thanks for watching.